Hello and welcome to the next installment in the Huntsville I2C Financial Boot Camp. Today, we're going to continue our discussion on financial ratios. We spoke in our last segment about balance sheet centric ratios. Today, we're going to talk about income statement centric ratios. I hope everyone finds this to be helpful as we work through this. I'm going to start as I did in the balance sheet centric ratio segment with a very fast review of what are financial statements, because these are the basis for the information that we're going to be using in calculating and analyzing these ratios. Very quickly, financial statements are an income statement, balance sheet, statement of cash flows, and notes to those financial statements. The income statement is a measure or an indication of a company's performance over some fiscal period. Think of it as a movie. The balance sheet is more like a photograph. What does the company look like at some particular point in time? The statement of cash flows is like an income statement, but on a cash flow basis. And the notes to the financial statements provide explanations of these numbers that you would find in these aforementioned statements. Limitations on financial statements are important to keep in mind because, of course, we're using the financial statements to make the calculations and perform the ratio analyses that we're going to be looking at. So recognize this information is historical. It's not fair market value, does not reflect fair market values. It's intended to be conservative, and it's limited to financial information. So you're not going to find the number of customers, I think, is the example I've used before, as a number you will not find in the financial statements. With that, let's look at the layout or the construct of an income statement before we get into the income statement ratios, so that we'll know exactly where we're pulling the numbers from as we're looking at income statement ratios. We usually start with sales, subtract cost of goods sold. That gives us some gross profit or gross margin. We then subtract operating costs, such as selling, general, administrative costs, and that gives us an operating income. Then we have other revenues and expenses that are unusual, non-recurring in nature, or this may be where we list our tax expense, and that gives us our net income number. So with this as the backdrop, let's jump right into income statement centric financial ratios. There are generally two types. The first is cash conversion or liquidity focused ratios. These focus on a company's efficiency and speed in converting activity to cash. Next is the profitability focused ratios that really are frankly more simple, and they tend to focus on how profitable a company is. Let's do the tougher ones first, which are the cash conversion and liquidity focused ratios. If we think about cash conversion, let's go to the bottom of this slide and think about the cash conversion cycle. DSO plus DIO minus DPO, and that's a lot of acronyms and letters. And what does that mean? What that means is what we're trying to measure here is how long it takes a company to begin its business activity, and how long will that take in days until the company converts those activities into cash in hand. So with that as the goal, we're going to look at how we construct that calculation. And each element is also important. Day sales outstanding, which is your accounts receivable or receivables divided by revenue times 365. This tells us, and the revenue number is an annual revenue. That's why we use 365 as the multiplier. So what is the accounts receivable divided by revenue times the number of days, and annual revenue divided times the number of days in a year? That tells us how many days it takes us to convert a sale to revenue, to cash, excuse me. So that tells us how many days our sales are outstanding. That gives us an indication of the turn of our cash in the sales cycle. Next, let's look at days inventory outstanding. That's inventory divided by the cost of goods sold times 365. And cost of goods sold is the annual income statement yearly cost of goods sold number. Here again, what we're measuring is the number of days our inventory is using our cash. When we buy inventory, we're using cash to buy inventory. How long is that inventory in inventory? How many days are we using cash to hold inventory? And then lastly, conversely, we're going to be looking at how long it takes us to pay our vendors. How many days does it take to pay our vendors? That's accounts payable divided by cost of goods sold times 365. So that's how long we hold other people's money. So if we want to talk about our cash conversion cycle of buying inventory and then selling that inventory and getting cash and paying our suppliers, that's our net conversion cycle, our net cash conversion cycle. So that's days that we have money outstanding in accounts receivable, plus days that we have money that's sitting in inventory, minus the number of days where we're using our suppliers' money, where we've perhaps gotten inventory but haven't yet paid for it. So that's the formula that tells us how many days are we using other people's money netted against how many days we're having to have our money tied up in the inventory and sales cycle. So that's a good reflection of how efficiently we're turning our money. Day sales outstanding, generally less than 60 is certainly where you want to be. Days in inventory, you'd like to keep that as low as possible too. Less than 90 would be good, and then days payable. How far will your suppliers let you ride them? And generally, that number might look like 45 days, 30 days, or something like that. That's to give everyone some sort of a baseline or reference. Working capital is the next thing that we're going to talk about. And technically, this is a balance sheet centric ratio, but I include it here because it relates to measuring how well we're able to and how quickly we turn our money and how well we can satisfy our current liabilities. Working capital is simply current assets less current liabilities. Let's next talk about days cash on hand. This is an important number, particularly for startups. This is simply cash divided by your cash operating expenses. So we exclude depreciation expense, but we take your cash balance and we divide that by your cash operating expenses times 365. And this tells us how many days of cash that we have on hand. How many days can we operate if we weren't to collect any of our accounts receivable? Days of current assets on hand, and this is current assets, which would include now inventory and accounts receivable. So this is more reflective, hopefully, of money that we either have in hand or will be coming in within the next few months, few months, so that we can use that money to meet the operating expenses of the company. How many days can we fund? So these are very important ratios to me as one thinks about budgeting and projecting how well the company can meet its immediate needs. Moving to profitability ratios, and I'll go pretty quickly here because these are pretty simple. Gross margin, we talked about. Operating income, net income, we already talked about in the construct of the income statement. Next, very importantly, many people pronounce this different ways. I say EBITDA, but this is earnings before interest, taxes, depreciation, and amortization. So this is a bit of a proxy for cash from operations. Not exactly, but perhaps a loose proxy for cash from operations. But it's your earnings before interest, taxes, and then the non-cash depreciation and amortization. This number is important because this is often used as a valuation multiple as people are thinking about the value of their company. And we won't get into what the multiple for EBITDA is, but a typical range might be as low as 3 times your EBITDA and up to, if it's a growing fantastic company, that number could get into the teens for an EBITDA multiple to reflect value. But a lot goes into that. Don't hold me to that multiple. I like to look at the return profitability ratios. I'm not going to spend too much time here because it's pretty simple math. But I want to encourage every business owner to think in terms of the return they can get on assets, return on equity, how much they've invested in the company, what sort of return are they getting on that equity, return on invested capital. The difference here is you're looking at equity and debt that are invested in the company, and what sort of net income are you generating using that capital. And then return on investment, which is the project net income divided by investment in the project. Obviously, we're in a low interest rate environment, and the United States government is able to borrow money at, around 2% or less, which is pretty low. And a company is typically borrowing money at something in the range of 4 to much higher, but say 4 to 12%, depending on risk associated with a project or an entity. So these days, you certainly want to do better than a borrowing rate as you make an investment in a project. So again, I provide that merely as context for you as to what numbers you ought to be looking for as you calculate return on your equity in the company or return on an investment in a project. And then let's get into the additional profitability ratios, which would include rate of return. That's the final value of a project minus the initial value or the initial investment divided by the initial investment. So that tells you how much you returned on a project based on the value that it might create. The next two are very closely related: net present value and internal rate of return. I would tell you, if you haven't done this before and you have access to Excel or some similar spreadsheet, you can simply Google, do a Google search for how to calculate net present value or the internal rate of return of a project. And generally speaking, the net present value will yield a kind of a go or no go type of answer for a project if you plug in the rate of return, internal rate of return, IRR, that you want on that project. And if you meet the hurdle rate, you'll get a positive net present value, and that means the project's a go. If you get a negative value, the project's a no-go. You can do a little algebra, and instead of calculating positive or negative net present value, go or no go, binary threshold, you can instead calculate the internal rate of return. If you assume if you force the net present value to be zero, then you get to calculate your internal rate of return. And keep in mind, again, what we were talking about a minute ago, that the discount rate associated with investing in a project or a company can be as low as 5% for a very low risk project to as high as 50% for a very high risk project. Again, if anyone wants to discuss any of these things, I'm happy to field a call from someone, but hopefully this gives everyone an indication or some good information relative to what sort of ratios should you be calculating using your financial statements, and what you can do with those calculations in terms of planning, budgeting, and decision making about your company. As we think about these income statement centric ratios, we look at, we want to be aware that these reflect period performance. The income statement reflects periodic performance for some fiscal period. These income statement centric ratios also addressed efficiency. How well is the company using its assets? How well is the company using its equity? How much risk is there within the company? And is the company getting returns that are sufficient given the level of risk that's within the company? And then lastly, talking about, as we look at the net present value and internal rate of return and the rates of return on projects, these ratios are very informative as to how should a company deploy its resources in order to be that efficient organization. I hope this is helpful. I hope it's informative. And as always, I enjoy my time with you and welcome any questions if anyone would like to reach out to me. Until we do another video, again, this is Roger Spain with Warren Averett, and I Hope to see you again soon.